Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about one of the most important retirement assets that you need to take into account when you develop a retirement income plan. But the ironic thing is that it's one of those assets that more often than not isn't even spoken to in the context of strategic planning for retirement. So I think you'll enjoy this video. Now, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content. We're posting content on retirement issues as well as overall wealth planning. So if you don't want to miss future content, hit subscribe. As well, if you go to the show notes, there's complimentary educational content that you can access. So there's links to that content. As well, you can find out how you can get a complimentary retirement income planning forecast. Now, before we get into a discussion on this key asset class for retirement income planning, I think we need to talk about the importance of building in optionality in your plan. So what do I mean by optionality? Optionality really refers to developing a plan that gives you a lot of different options for dealing with uncertainty through your retirement years. So there's no doubt that we live in a world of uncertainty, and we can do all the planning in the world in terms of forecasts and assumptions and how are we tracking relative to our goals. But the reality is we don't have a crystal ball. So because of that, you need to build in that maximum flexibility and optionality into your plan. Now, there's some classic ways that we do that, right? We will look at a retirement income plan and we'll look at timeline investing. So the image you see on the screen takes a look at dividing your retirement investment portfolio into three main categories. The short term, which is for income and liquidity needs over the next few years. Medium term, which is money that needs to be delivered to you over the next 4, 5, 6 years. And then longer term capital. And then tied to that strategy is the idea of an income wedge, which is essentially portioning out a part of your portfolio in investments that are not tied to the market, that are guaranteed and don't fluctuate. And in times of market uncertainty or economic calamity, you know you've got these guaranteed investments in place to generate income for your retirement. But even those plans can go sideways. You could build a very solid portfolio, broadly diversified, have cash positions, and have great diversification. But there may be times when you generate retirement income that you have to default to alternative strategies. So we classically will look at our company pension plan if we're fortunate enough to have it, our Canada pension plan benefits, our old age security benefits, and then draw money from our portfolio to produce income. But what do you do during times of market uncertainty when the performance just isn't there? What happens when you go through more of your cash accounts than you hoped to have gone through? So you went through it too quickly in your circumstances. So that's why you need to look at your retirement income planning and build optionality by looking at your retirement portfolio as your overall net worth or balance sheet. And one key asset that plays a role will be your real estate. So whether it's your cottage property, your principal residence, or other real estate. And very often retirees are very reluctant to integrate those assets into their plan. And I get it. I mean, they don't want to do it because there's emotional attachments to those assets. Maybe there's legacy aspirations for some of those assets. And of course, there's a real strong attachment to that real estate. But at the end of the day, you want to make sure you think about this optionality in worst case scenarios. And so one of the things we say to clients is, during times of uncertainty, one option that could make an awful lot of sense is to leverage off the equity in your real estate short term if you need to. So let's say your investments aren't doing well, you still need to generate cash flow. Well, then you can use a line of credit or a reverse mortgage or some sort of lending facility to tap into the equity in your real estate to generate cash flow on a tax-effective basis, because that income will not be taxable to you. And of course, there will be interest costs. But when you look at the overall planning, having the ability to leverage off balance sheet equity in real estate sometimes could really come in handy. Because when you think about it, when you're trying to generate income from your RSP account or your RIF account, for every dollar of income you're trying to generate, you might have to sell $1.25 in investments because of the tax aspect. Well, if you add on to that volatile markets where maybe your investments are down, there's a big cost to pay. So by having a line of credit, a secured line of credit to keep the costs as low as possible, during those harder, more difficult times in capital markets, you could tap into real estate equity. If you need to generate $1, it just costs you $1 because the assets coming to you are not taxable. Yes, you're going to have the short-term interest costs to access that equity. However, you can buy yourself time, allow your portfolio to reconstitute itself, and then eventually take capital out of your portfolio to pay down that indebtedness. So the next takeaway from this discussion on building optionality, looking at your retirement income plan as a balance sheet discussion, is to make sure you get your credit facilities in place before you retire. Often people are surprised when they go to their financial institution, they're already retired, and they want to get a loan or a line of credit, that they're met with a little bit of resistance. And the reason for that is many financial institutions ideally like to see employment income on that application. And when you cannot give them that information, it's more difficult to get approved lines of credit or get the lines of credit amounts that you'd like to get. So don't wait until you're retired. Before you retire, make sure you get your credit facilities in place. It's an easier process. And once it's in place, they're not going to come back and try to re-underwrite that line of credit. So make sure you get it done before you retire. So that's the discussion on optionality. Again, in a reasonable world, more often than not, you're going to use your RSP accounts, your RIF accounts, your investments, maybe TFSAs that you set aside for retirement to supplement your other forms of pension income. But during times of market volatility, and we know that roughly 75% of the time the economy is growing, market's doing okay, but there will be that 25% of the time when things can be volatile. So by building the optionality into your planning, looking at your retirement income as a balance sheet discussion, you'll just be a little more defensive and a little better prepared to deal with the uncertainties that come your way through your retirement years. Hope you enjoyed the discussion. Again, if you haven't subscribed, make sure you do that so you get alerts to our regular content that we're uploading. As well, if you go to the show notes, there's complimentary resources that you can tap into, and you can find out how you can get a complimentary retirement plan. There's a link that will take you back to our website that discusses that. Anyway, wishing you all the best in your retirement and overall wealth planning. You take care. Bye-bye.